All right, now we're going into new business, tentative budget, first read.
Are we actually done with all old business? Or
That's all, I don't have any action items for old business.
Kevin, Dr. Skikas, do we complete all that old business?
I believe so. Right, Miriam?
I think so too.
Thank you.
Okay, so we're gonna move on to tentative budget, first read, page 72 of our board book.
The Finance Committee met last week to review the tentative budget first draft. The board will have from now until the July board meeting, I believe it's July 9th, is when we'll be meeting and asking for the board to approve the tentative budget to be on display for 30 days. Tim McGinnis, myself, and the building administration and building staff have been working on the budget. Tim will provide a summary of what you're going to see tonight. We've worked very hard on this process over the last 2 years that Tim and I have been here. We're both starting our third year together. I don't know if you, for those of you that don't remember, the first board meeting that Tim and I attended 3 days on the job was your first budget meeting in July for a budget we didn't prepare. And boy, we were wondering what we got into. But at that time, we were looking at a budget with a deficit of $1.3 million. And 2 years later, at the start of our third year, we're presenting a budget to you with a surplus of $270,000. We've made some tough cuts, but we've also, with this budget, have re-implemented 3 teachers to our teaching staff, another academic support position, a behavior intervention position. We implemented back 2 assistant deans, or assistant athletic directors. We've also put some money in here for technology. We've put some money in for capital improvements. I think there's some things that we've done operationally that Tim will touch on in regards to joining an insurance cooperative, working on all our early retirements and eliminating all of our early retirement penalties, working on our staffing to minimize classes under 20 students. So we've put in some operational controls as well as working with the staff to identify priorities, and we've actually gotten to a point to where we're now implementing additions to help with interventions to help with our goals. So I will let Tim speak to that some more as he presents the first draft of the budget.
Yeah, as Kevin said, the timeline is that the budget has to be approved, the final budget has to be approved in September. We need to have the budget on display for 30 days prior to that date. So because of the date of the September board meeting and the August board meeting, the tentative budget has to be approved in July so that it can then be on display. We have the more than 30 days from the July meeting, obviously, to the September meeting. We don't have that much time from August to September. So that's why we're asking for approval next month of the tentative budget. It's not to say that we can't tweak it and make different changes and things like that, but for the most part, that would be the budget that would go in as the final budget in September. As Kevin mentioned, this budget has a surplus of $270,000. In putting the budget together, by the time that I got the May financial statements, there wasn't time to get it into this document. So that's why there's no actual numbers in here. To put April in here, it wouldn't have presented a very good picture. The budget, you'll get another copy of this in July, and that will include the May actuals, okay? You'll also get a copy in August that'll include the June actuals, so you'll see the actuals for the year. Just to give you an idea of the process that we went through, each of the department heads, each of the administrators was asked to complete budget worksheets for each of their accounts, other than salaries and benefits. And they had to provide a justification for the amounts that they were requesting. Okay. Then what I did was, when I got them all back, is I sat down with Pam for most of the departments in terms of English and math and those types of things. And we went through it, and we looked at the budget requests that they had. we looked at their budget amounts for this current year, then we also looked at the actual amounts that they had spent, I believe at that time it was through April, and made a judgment in terms of whether or not we were gonna give them, the entire amount. If, for example, they had a $5,000 budget this year and they only spent $1,000, we weren't gonna just automatically give them $5,000 again next year, unless they gave us some kind of justification in terms of why they didn't spend it this year and they were gonna spend it next year. So there was a number of budget line items that were reduced from what the requests were. There was also a significant amount that was put through at what the people had requested. And our idea was that we would put through the numbers for each of these accounts, and then overall, when we got to the end and looked at the overall number on the bottom line, determine whether or not we had to go back and make some adjustments to that type of thing. Kevin and I sat down after Pam and I did, we reviewed the information, and then Kevin and I looked at a number of the other departments. We sat down with Joel and looked at the operations budget, and made decisions on each of his accounts in terms of what we felt we needed to do in budgeting for next year. Again, in line with what was the budget for last year, what did we actually spend, and correspondingly, what do we have to do for the next year? So that's kind of the process that we went through. Pam then puts together the staffing based on the restrictions that she has in terms of number of people. We have a 25-page document that we call position control, and it lists out for every department the people that were in that department last year, the people that are going to be in that department next year, and it totals it out so that we come exactly to that 89 FTE and certified staff. Once Pam identified the individuals in each of those departments, we went through and in the business office, put together this document and took all of the certified staff, increased them by one step, okay, which is, because we're still bargaining. There's about 22 people, I think, that are at the top step. They're at step 20, so they didn't get any kind of an increase. They just stayed at the same amount they were at. That's why if you're looking at the overall increase in salaries, you're not seeing an increase that you might expect, because there are, a large percentage of the staff that don't get any kind of an increase. We increased the non-certified staff by 3.5%, because again, that's within the contract. We left the stipends basically the same. Now, in some of the areas where we have the stipends, the amounts may change. In athletics, for example, if we change coaches, then the amount of the stipends, if you're looking at the budget, may be different next year from this year, because there's a change in the coach and there's a change at the level that he gets paid at in the contract. But if you do look in athletics, for example, you'll find that the vast majority of those stipend amounts, that the budget amounts are the exact same thing next year as they are this year, okay, because we didn't change the stipend amounts.
So if somebody was at the top, they're not changing.
Correct.
And there's a lot of people at the top.
Right.
But if somebody's at a lower level, and they're gonna come
Right.
and they're gonna go up the next step, right?
Right. Majority of the department chairs, for example, I think make $8,943 this year. That's exactly what we have them in the budget for next year.
Were you talking wage or salary or stipend?
Stipends I was
Oh, I was-
talking about.
Yeah, this stipends, yeah.
Unless you hired a coach who's now more experienced, it would go up. Or if you hired a coach now who's less experienced, it would go down. Otherwise, it should be the same.
Correct.
It shouldn't change unless.
Anybody who's not at the top step's gonna go up next year on a stipend, right? If they
No,
stay
No,
the
We're
same.
not-
the stipends are.
1 through 7
1
and
through
8
7, you get a
plus.
certain amount.
Oh, so it's
8
just-
and beyond, you get a
okay, so
different
it's
amount.
just
Unless
that
you went
one-
from 7 to 8,
Seven,
or
okay.
if a top coach
Right.
retired and we hire here.
Okay.
Otherwise, it's gonna be off the same page.
I forgot it was 1 through 7 and then 8. Okay, thank you.
I included I get the page number here.
Page number 74, or 73.
Yeah, page 73. I gave you a comparison of the significant changes that we had from the fiscal 13 budget to the fiscal 14 budget. And tried to give you on the top, the revenue, a significant amount of those are the revenue items are increasing, okay? And I tried to highlight just the significant ones. Taxes, for example, Real estate taxes overall are gonna go up, this is just for the operating funds, gonna go up by $633,000 next year. The food service, $15,000, that was based on the agreement that we signed last month with District 95. And I'll get into more of these when we cover the assumptions, but those are just a listing of the items where we're seeing significant changes in the amount of revenue that we're gonna get next year. The negative amounts reflect reductions in revenue. Registration fees, $43,000. General state aid, $81,000. And again, when we get to the assumption page, I can explain a lot of that detail better. But you see that just on those items there, about a $698,000 increase in revenue from fiscal 13 budget to the fiscal 14 budget. And then the expenditure decreases, again, some fairly significant things. The $164,000 for salaries is actually an increase in salaries, so it's a negative number there. But ERO penalties, we're picking up $182,000 in reduced expenses for ERO penalties. The same for retirement incentives, $54,000, the self-insurance run out. And you can see there that just those significant items alone, we're reducing our expenditures by $230,000. So that's what's creating, a big part of this swing from last year to this year, from going from a deficit situation to a surplus situation.
Assumptions?
So if we go to the assumptions,
So the big story on this page says the revenue increases primarily are coming from, and this is operating funds, coming from real estate taxes. And the expenditure decreases they're kind of reflecting the kind of work you guys have been doing for, finally, the fruition of the work you guys have been doing for the last couple of years. $240,000 reduction in health insurance. You're getting control over retirements. I mean, that's another $230,000. Those kind of things, that block and tackling that you guys have been devoting to and looking at. I mean, I looked at the O&M budget, and now you're getting about $140,000 in building rentals. I mean, this is kind of stuff that's finally coming to fruition with the work you guys have been doing, and I just want to say thank you for the work to get this in position. Now this is operating, so it's $633,000 increase in real estate taxes, but on the bond fund, we did not levy, or the levy goes away for working capital, one of the working capital, right? To the reduction of how much, roughly?
it goes down, well, it's
Is it at the bottom of the page there?
It's 6 something, is it?
688.
yeah.
Well, that's the expenditure side, right? So we're gonna also have a
net.
reduction in revenue, right?
Revenue side, which I have to put into there, yeah.
Right.
That was brought
So
to
we're
light.
gonna have a taxpayer's gonna see,
We're seeing a debt service tax rate going from 67 cents to 59 cents
Okay.
next year. Because we're seeing a reduction in the payment. This is our final payment next year on the working cash bonds, so we're seeing a much lower payment next year. It's dropping, I think, almost in half. The following year, it's gone, so that tax rate will go down from 59 cents to 49 cents. Okay, if you remember, those are the numbers that Elizabeth Hennessy worked up when she came out here and made her presentation, I think, in October.
So the taxpayer will see a slight decrease.
Yeah.
All right, 76, you want to go?
Let me
Okay,
just ask one question on the salaries to make sure I get my head around this. So 22, roughly a quarter of our teachers are at the top. So based on the contract and the status quo ante, they're not shown to get any change. And then the rest of the employees, because of the status quo ante, we show them going up a step, like you said. But even with those, because the average increase for that is about
4%.
close to,
Close
is it
to
four,
it's
more
almost
than that, isn't
4%.
it?
It's close to 4%, the step increase is 4%.
So the other change is that we have 3 more teachers next year roughly, right?
Yes.
yes.
Plus 1.5 non-teaching.
Right.
2.
Interventionist.
So the other reason is, as Gary pointed out, that we've had a significant number of retiring of some of our highest paid employees.
Yes.
and then we've hired teachers to replace them at the low end of the scale, right?
Correct.
And in some cases, it's close to $100,000 difference, right?
Yeah, the top salary for masters plus 45 is $132,000.
And the starting is.
The starting is
54.
54,000, so.
So it's $80,000
$80,000,
difference.
yeah.
Okay.
So you almost get the 3 new teachers for one high-paid teacher coming on.
On salary, but not on
On salary.
benefits, so.
Right.
Okay, let's go to page 76 for your assumptions.
Okay. If we go through the assumptions on the revenue, real estate taxes, the last page of the budget detail shows the calculations for each fund on real estate taxes. And again, what we did this year is we took it 98%, that we were gonna collect 98%.
What page you're at, Tim? 114?
No, he's taking you to the chart at the end of the budget.
Yeah,
Why don't you move-
114.
why don't
yeah,
you move
114 is, and I'll move that up.
to the front,
To the
behind the
front.
That'd be
assumptions, so
nice.
they can see how you got there.
Yeah,
But we used the 98% number again. That sheet on page 114 shows how the calculation is done for each of the tax collections in November and then again in March. One of the things is the levy that we did last December was at 3%. But you remember, we didn't just do 3% across the board for every fund. Basically, we reduced the operations fund by over $100,000 in terms of the levy. And we kept transportation and IMRF pretty status quo so that we could take the majority of the increase that we were going to get and put it into the education fund. So that's why if you looked at just the education fund levy, it's going up fairly substantially. It's gone up by more than the 3%. That's because that's where we put that bulk of that increase that we were going to get. And correspondingly, if you looked at operations and maintenance, you see a reduction in the tax levy because we reduced, or in the tax collections because we reduced that levy. It was just a matter of trying to figure out where we needed the money.
the 98%, at least compared to the current year, is a bit conservative, right? Because we actually collected over 100%, didn't we, this year?
Correct.
Okay.
Yes.
At least compared to this year. It might not be compared
Right.
to other years, right? Okay.
The tax refunds, the budget for next year is the same as we had for this year. Now, we didn't have the refunds this year. We came in, I want to say at least $300,000 under budget. But in talking to our legal counsel, we still have outstanding property tax appeals out there from Riverside Golf Club, North Riverside Park Mall, Sears, Harris Bank, McNeil. So there's some pretty significant appeals that are still out there. And I hesitate to reduce that budget amount down, and then we end up getting caught with some fairly significant property tax appeals. I mean, our property tax appeals about 3 years ago, I think, came in at about where we're budgeting. We're budgeting $850,000 with all the funds. That's about where we came in about 3 years ago because we had some significant.
What about the other side? Is it possible if those appeals are significant enough where we could have a significantly greater reduction in revenue next year?
Say it again, I'm sorry.
Well, the properties you mentioned, or the owners, they're pretty significant properties. If they were all successful, would we see possibly a much more significant reduction in the 850?
In talking to the attorney that we use at Franzik Rattlet, I mean, I gave him the amounts. He felt that was
Okay.
a sufficient amount to put in there. General registration fees, we reduced that to $225,000. That's about the amount that we've collected in fiscal 2013. We collected less than we had budgeted. I think part of that is just, we had a higher free and reduced population that doesn't pay the registration fees. And again, as was mentioned earlier, some of the people who aren't free and reduced in the past have paid the registration fees even if they got free and reduced lunch prices. This year, we've seen more of those people, asking for waivers on the registration fees. And we do have a number of payment plans out there that people are making and that type of thing. So the amount that we collected was less than we had budgeted, and I think we need to bring that budget down next year to a more realistic number. The pay to participate number is basically the same as what we've collected this year. Now, that we can change, obviously, if you make a decision to change how much, we're gonna charge for the sports and the clubs, we can adjust that number accordingly. The food service, as I mentioned, I plugged in $15,000. That's the percentage that we should receive on the sales. But one of the things that I didn't put in there that was brought to my attention that should be is, there should be a line item in there probably for about $215,000 in revenue that's coming in from District 95, and then $215,000 in expenditures that's going out to Quest, because Quest is we're gonna bill District 95 and Quest is gonna bill us. So that would be an offset, but those amounts should be included in here. But the $15,000 is like a percentage that we're gonna get on the sales. So that's definitely an increase in the revenue.
Thank you.
General state aid, the general state aid formula is based on the number of students you have. There's a foundation level, which the state says every school should receive $6,119 for every student. Then they go, once they calculate that amount based on the attendance numbers that we give them, in June I give them the attendance numbers for the year, and then they use that to calculate what that amount should be for next year. But then they reduce that by local resources. So they take all of our property taxes and they reduce that. If they take 1,400 some students times $6,119, they reduce that amount by the local property taxes. They reduce that amount by the personal property replacement tax, which is an income tax on businesses in the district. And they calculate the entitlement of what we're supposed to get. This year, we got 95% of the entitlement, because when they budgeted, they said, we're not gonna pay that entire entitlement, we're gonna cut it by 5% for every school district. One of the things they're talking about for next year, and I don't think they've settled on it yet, is they may cut it another 10% and actually give you 85% of what you're entitled to. So that's the number that I put in the budget. So that's why there was a decrease in general state aid that went from the budget of $793,000 to next year's budget of $712,000.
And Tim, just all said and done, by the time they apply our property taxes on a per student basis, we're getting about $800 per student, something like that. If I remember, I think I did on an envelope,
Yeah.
back envelope kind of calculation. So it's not a significant per student. I mean, it's overall, it's, 1,400 times 800, 800,000, whatever, but, I mean, that's been steadily decreasing on
Yeah.
our, right? We can't rely on that, and it's been steadily decreasing.
Right, and as you see, I mean, the amount that we get from the state for general state aid
Yeah.
is minimal. There are districts that get a third of their revenue comes from
Yeah, it's
general
less than
state aid.
800 now.
So
Yeah,
Less than
That's
5.
no, yeah, looking at 793 on 1,450 students, it's actually 500-ish.
Even less.
Yeah.
Yeah.
I mean, I think a couple years ago it was over 1 million, but that's steadily been decreasing. So, okay.
Special education, included in the revenue, there's a special education grant, about $30,000 this past year. We haven't had anything budgeted there, because what LADSI did is they took that grant money and they applied it against their expenses. They can't do that for next year for some reason. They can't apply it next year. So their expense is going up, but we're also gonna get an increase. We're gonna get $30,000 in revenue on this grant that we didn't have last year. State reimbursements, what they call mandated categoricals. We get reimbursements, and they're in the education fund for special ed personnel, for special needs students that are placed in facilities, and then what they call special education extraordinary expenses. There's also a reimbursement that we get for special education transportation. That's in the transportation fund. So in the education fund, I've increased the revenue by $109,000 in the education fund for those special ed reimbursements. And in the transportation fund, I've increased it by $75,000 for the transportation reimbursements we get from the state. The reason being that that when they calculate the reimbursement that you're supposed to get, again, the state may determine, and they have in the past, they're supposed to make 4 payments, paying quarterly. There are years in the past where they've made two payments and said, okay, we're not gonna make any more of the payments, just because they didn't have the money. So last year, we were pretty conservative. This year, they're making, I think they're gonna make at least 3 of the payments. So it looks like, they're starting to catch up on that. So that's why I've increased the budget in those line items. You'll see when we get the actual numbers, that the actual revenue that we've gotten in those line items is over budget by a fairly significant amount, because we have gotten that additional payment. There's a federal Title I grant. It's increased from about $60,000 to about $93,000. I think $68,000 up to $93,000. That amount has gone up. We've gotten significantly more money there because our allocation went up, because we didn't make average yearly progress. So what they do is they give you more money for services that you can go out and hire companies to come in and do tutoring services. They give you additional money for professional development. But our allocation for that Title I grant has increased.
It's important to note that although that increase is there, somebody might say, well, that's $73,000 that you can add right away to your staff, or it has to meet specific criteria that the federal government has aligned for intervention implementation, and a lot of that is outside third-party interventions. So before you can actually use that, you have to go through several different processes to show that you've exhausted all means of using outside third-party tutoring services or interventions before you could apply that to hire an additional staff member or do an internal intervention.
Yeah, and so what you're seeing on the revenue side is that $93,000. On the expenditure side in Title I just put the $93,000 in salary. That grant hasn't been written for next year, so there may be some changes in that some of the money may come out of salaries and go into supplies and that type of thing. But since the grant isn't written, I wanted to plug a number in, so I just plugged it all into salaries.
Expenditures?
Pardon?
Expenditures?
The last line.
Yeah, just one more. And the operations and maintenance fund, last year we had money budgeted, quite a significant amount of money, state revenue budgeted from the Department of Commerce and Economic Opportunity. We're not expecting to get as much money next year from that, so I've reduced that state revenue account because of that. We also had some local revenue that we got that went into that. We got money from the boosters, from the senior class. We also got, for the sign. We also received money from Airmark. We received a $40,000 grant from Airmark that became part of our revenue in the operations fund. And we did have some money that we got from the insurance company on insurance loss that we had. Okay, I'm obviously not anticipating those things for next year. So that's why the 2 line items in the operations and maintenance fund show a fairly significant decrease in terms of the revenue on those 2 line items.
Is that 50,000 grant we just put in for the state maintenance grant?
We have 50,000 in for
Did they
next year.
approve that or
That's
not?
the state maintenance grant that you approved last month, yes.
Oh, it got approved? I mean, did the state approve
No,
it?
you approved it. No, it went to the state. I've got it in here, but it hasn't been approved by the
Will
state.
we
And you got a
know?
corresponding expense, right?
Yes, our architects estimated that the expense for those roofs was $120,000.
Yeah.
So the expenditure side, there's $120,000. This is the $50,000 in revenue that we're gonna get from. So the net is a $70,000 expense that's in here.
But when will we find out before this budget is approved whether the state approved that $50,000 grant or not?
I don't know. I don't know when the state will make that, determination. On the expenditure side, again, some of the things we talked about. Last year, we budgeted the run out on the insurance claims from the old insurance. That was $177,000. And the ERO costs were $182,000 up. Those numbers will be put into the assumptions the next time you see it. But those are 2 fairly significant items that we talked about on that comparison sheet. The retirement stipends are down about $54,000. We still have some retirees that are still in the pipeline that are getting some retirement stipends, but it's dropped significantly. The budget for insurance cost decreased $71,000. That was a decrease in the premium that we talked about that we received from, and that's, you know, part of the benefit of joining the EBC, the cooperative that we're in, is that there's more stability in terms of what the increases are gonna be. Part of our experience was the fact that we had these runout claims that we paid out to the prior insurance carrier, but I think overall, this insurance pool is gonna give us a lot more stability in terms of rates. And I also put a note in here that last year we took all the insurance expenses and we put them into one account. You'll note we took life insurance, health insurance, dental insurance out of all the different departments, stuck it into one account in the education fund. We have to have some of those insurance costs in the special education because they monitor how much we spend on special ed every year that the federal government does. And we can't, if we show a decrease, then we lose some money on grants. So I took some of the actual expenditures we had for insurance, transferred it over into those special ed accounts this year, and next year we're budgeting those numbers in there. We're also budgeting numbers in the superintendent's office, in that account. The question was raised about administrative cost cap. There is a limitation. Your administrative costs can only go up from 5% from one year to the next. Those administrative costs are only for the superintendent's office. It doesn't, you would think administrative costs would apply to a lot of different offices. It would include my office maybe and the principal's office, but it doesn't. It's strictly the superintendent's office. I plugged the insurance expenditures back in there, but we're actually going to see a decrease there because we had the human resource person that we had last year was under Kevin. You know, we've transferred those responsibilities to someone in the business office, and that individual is now working in the principal's office. So
I suggest we put something in there, a chart or a language, so that every year there's an affirmative discussion about whether we aren't going over 5%, because there's a statutory requirement that we have to notify the ISB, right? And we have to have part of the public hearing if we go over 5%, don't we?
right, and this is something that usually comes up after the audit's completed, like in October, November. I think the deadline for submitting the information to ISB is November 15th. And this is usually something that comes up. The auditors have to, they have to complete the forms. It actually has to come here and be signed by the board president, and be sent in to
But I thought there
state
was a
board.
requirement that if we know the budget's gonna go up by more than 5%, we have a reporting requirement too. We don't?
The overall budget or just the
For the
budget?
administrative costs?
Yes,
Okay.
but it hasn't been the case.
So my only point is, because it's one of the few statutory requirements in there, I think we should make sure every year we're putting some kind of affirmative language in there that the administrative costs are not going up by more than 5%, so that everybody thinks of it every year.
A general assumption.
Yeah, I'll put something into the assumptions
So
on that.
maybe that's what you should do on the assumptions of those, even the grant ones, maybe you should,
Leave those
that way
first.
those are identified for us to quickly see, you know, and with the administration one, the overall increase, things like that.
The ones
There's a
that are
check-
annual.
Yeah,
That's an easy fix.
yeah.
Keep going, Tim.
Then
you're
I
doing
had
a
some
good job.
information there on certified staff, the increase of 3.1 FTE. The non-certified staff, the stipend amount, we've already talked about that in terms of the dollar amounts, those were going up. Board professional services, we've increased that up to $80,000. That's to cover the expenditures that we've already approved with the architect for the safety reference plan and the life safety plan, and then some additional money in there in case there's additional expenses for the architect, depending upon what other things we may have them do.
What about the legal fees come under board expenses, don't they, Tim? Our legal, two
Yes.
legal law firms?
Um,
I mean, didn't we budget additional cost this year for the union negotiations?
Left
That
them the same, I believe, because
Yeah.
we increased them significantly last year.
And we think that that's going to continue through next year?
The pace we're on right now with the actuals, we should be all right.
Okay.
We significantly increased them last year.
I know we did. That's why
So
I'm
that-
wondering if,
We've held them, I think if anything, we went down 10,000, we decreased it by 10,000.
okay,
But we're still at about 100,000 for legal fees.
okay.
There was a question on special ed tuition. We've budgeted that the same next year as we had this year, although this year we've spent about half the money that we had budgeted. And that's really just based on the students that you have. When Kevin and I sat down with the special ed director, she identified the students for next year that look like we're gonna have to outsource them and pay tuition. So we're leaving that budget amount the same. Next year, it looks like we're gonna use that amount. LADSI expenses, I put down to going up by $25,000 to $319,000. There was a note in there regarding capital, non-capital equipment increase, $50,000 to $100,000. That's actually specifically in the technology budget. I didn't put that in the, I'll highlight that in the assumptions next month. And the explanation.
Technology, when we were doing the PMA and some of that, I started to tell you, we need to start put that money away for technology initiatives and technology plan. So we put that in there to start looking at infrastructure and teacher resources.
You know, when we had the meeting two times ago, the board said they were gonna have a conversation whether or not we thought it was important to start putting money in technology and capital. Did you do that for this round?
Yeah, that's it. That's why it's increased.
Okay.
And the explanation simply, if you go through the budget and you're looking at non-capital, capital, the district made a determination a number of years ago that they would capitalize anything over $1,000. So capital is anything over 1,000. Non-capital is things under 1,000, which is why last year we had fairly significant amount of non-capital because we're buying computers. For the most part, they're under $1,000, so they become non-capital equipment. As I mentioned, the operations capital expense accounts, I added in $120,000 for the new roof. That was going to be partially offset by the school maintenance grant. And then we added an additional $100,000 to cover some additional non-life safety capital items that we don't know about right now. Obviously, we're not going to spend the money if we don't have those expenses. For transportation, I increased that by 10%. This budget was created before we opened the transportation bids. We're not going to see a 10% increase. That'll probably be changed by the July budget. You'll see that come down.
Well, we're gonna talk about it later, aren't we?
Yeah,
Sorry.
5,
5.
right? Close to 5?
yeah.
All right.
And I think that pretty much,
Do we have to worry about retirement costs being pushed to the district this year? Or we're not gonna include that in our expenditures?
it's
No,
not.
I think she's asking if pension law changes.
Pension laws?
I don't think in either of the Senate
Yes.
or the House, they're talking about pushing anything down
Not
at this
yet.
stage. They're talking about having individuals pay more,
Okay.
but that's on the individual taking a bigger, on one proposal. The other proposal is to cut a lot of their benefits and increase retirement age on the Senate side. But I don't think there's any, right now, that either plan has anybody pushing down.
Tim, electricity, why did we go down another 75,000?
We had a budget of $400,000. We're not even going to get close to that, I think.
But I mean, there's very good projections on what the cost of electric and gas service are going to be for the next 12 months. I mean, the better way to do it is not look and see what we did in the past, but look and see what they're projecting for the future.
Okay, I can look into that a little bit.
If you want, I could send you some links, if you'd like.
Okay, that'd be great, appreciate it.
All right, so this is the first read. Is there any questions or, two key things I think that, Tim, you didn't put out there was on expenditures, we increased our certified staff for this budget has been increased by 3.1 full-time positions.
That's on
Yeah.
there.
Okay, but you didn't say anything about
Okay.
it. And then on non-certified, let's see, and we also,
We increased non-certified with another academic support. The LADC staffing won't show, but we increased 1.5 in our LADC staffing, or excuse me, 1.0. We added a 0.5 transition specialist and a 0.5 behavior interventionist. So we increased, we had a 2.0 in non-certified, 1 security, 1 academic support, 1.0 in LADSI, and 3.1 in certified, so we added about 6 additional staff members.
Tim, in your conversation, I'm assuming you had conversation with Ladsy on budgeting this, with their significant, with the major pullout from Hinsdale. Did they try to talk bigger increases in expenditure, in cost of services, or are you seeing any of that in their cost of service?
I don't think we're seeing that in the increase. We're seeing that increase of 25,000, but I don't, it's not, I don't think it's a reflection of what, that they're trying to charge more because of the pullout. I don't know.
Right, I think also what you'll see is the next year, because there were some exit fees and things.
Okay.
So it's usually a year in arrears. So you
Yeah.
might see a slight increase in pay for service next year.
So do any of the Finance Advisory Council members have to say anything? Because you looked at this budget too. Mike?
You know, what we have in this budget here is, you know, a process of what the board has asked the administration to do over the last couple of years. And the direction of trying to reduce costs on one side. You know, some of our income is not really something that we can adjust very, very much, but taking a hard look at our expenses, and I think the administration and the business office has done a very fine job in the last few years to make some significant changes that Gary previously called the, you know, block and tackle type changes that, you know, going from the insurance co-op has helped, looking closely at our expense line items and our supply line items and the things we've done in the retirement area. And we finally have found that we could put a little money aside for technology potential. And we have a couple other things that are hanging over our heads, like roof expense and what we might have to do with the pool. It might cost more to litigate that than to actually pay for the expense ourselves. Although the email that came out right before the meeting, there might be something to work in that area. So I think they've done a very good job, and they've looked on in a lot of places to see where we can improve, and this budget shows that the hard work that the board has been pretty demanding over the last couple of years to get to this point. And I was quite happy with it, and I think you know, he's covered the major points, but I think we're sitting in a good position right now before we have to finalize it. This is a really good tentative budget, in my opinion. And so thank you for all that hard work, Dr. Skinkis and Tim, the business manager.
I agree with that too, and I think I would just caution us to be conservative on our assumptions on the things that we can't control. So leaving the numbers where they were on that one item, I think, is correct. Talking, you know, following Tim's advice with respect to the utility costs going forward, you know, I just caution us to be conservative.
Gary, you have anything to
Yeah,
add?
a couple of things, as I mentioned before, all the fruition of the work coming through on the expenditures. I just want to, you know, and what we're seeing in this budget is things on a it's no longer stabilization. We're moving forward with the increase in personnel. But I want to also highlight to the board that we're budgeting almost $300,000 in between architects and roof and technology, and that's something to ponder and think about as we talk about this budget next time around. You know, just to highlight that there's $300,000 of new expenditures in there for the architect, the technology, and the roofs, and just that's probably something we really should discuss as a board. Make sure it's hitting what we want, you know, going forward. Part of our.
You can consider that capital expense then, the architect and the roof? Is
Well,
that
I think part of the architect is the fact that we're doing the life safety evaluation. But I think some of it is also possibly as a contingency because of our pool and potentially the problems that we may run into and have to incur some cost to get the pool, to get people to move forward on the pool.
We also increased the architect above, well, the professional services above the number that was aligned with the life safety, because eventually we're gonna have to start paying them to start developing a plan for us of how we're gonna fix. Remember, that's not in the part of what we paid them for to do the life safety and the facility plan. So when we start getting into, okay, here's the life safety and here's the amendments that were approved, now we have to start paying them to start designing solutions. So we have to include that in there as well.
You know, and the other, and we're gonna be starting spending on technology, so, I think the board should get comfortable that there is a plan for the technology, because we're earmarking 100,000. So I'm just raising that as a positive thing, because we're able to put money aside and go forward and start moving forward on things.
Anybody else?
Yeah, first I'd like to say I thought you did a really nice job on this, Tim, and especially the explanations. And I think it's improved since last year. On the other side, I did have comments throughout your chart, and some of them you explained and some you didn't. If you just would consider them, and I'll look at them, when you do the revised draft. Except for one, I really would feel very happy if we can actually put a description for all the fields in here, so that, we know exactly what the expenses, or the revenue or expenses. I asked that before, and you said you thought you could do it. But in neither case, in the revenues or the expenditures, do we have a description for all the columns where there are codes. So every time you look at it, you don't know exactly how it's being broken down. I think it would make the budget even look better. So if you consider some of the formatting things, or like getting rid of all the lines that are zeros, probably take 5 pages off of the thing.
Yeah.
When you're going through, again, if it's not an unreasonable amount of work for
With the
you to do.
descriptors, you're saying per line?
I'm saying that there's 5 account lines, and in either the revenues or the expenditures do we say what all 5 of the fields stand for. So some of them, you go through and it's described exactly the same way, and it's 2 different line items, because there's some meaning to a code that's not described in there.
Yeah, you're saying at the top where it says account 1, account 2, account, yeah.
Yeah, and I know account 1's the fund, so you don't have to put that down, but if you look at the first page of the revenue, on the second grouping, there's account 2, account 3, account 4, account 5, there's numbers in all but 3, but there's not a description of the whole thing. And you do the same thing on the expenditures.
I
The
thought-
account 4 is not described in there.
I thought last year or the year before, we did a general summary of.
Yeah, but, again, it's a product we want to put out there, we send it to the state, or we want to understand, the people want to understand it, and there's codes in here that we don't describe. And no, the list we gave was missing the same data on it, because you sent it to us in Excel one time, remember?
I thought we made a summary that we were gonna include on the first 2 pages. I thought we did that in a previous.
Well, I think,
We weren't able to break down all 1,000 line items.
no, and I don't think, I think what you're asking for is the descriptions at the top.
Yeah.
Instead of saying account 1, put fund. Instead of saying account 2, it's,
Yeah, the variable labels.
yeah. just-
No, and I disagree with you, Kevin, it's a table. So each one of those codes, account 1, 2, 3, 4, 5, means something.
The variable labels.
And if you look
that they're
at,
missing.
if you look at the first line under revenue, it says current year tax levies.
Mhm.
If you look at the 4th line, it says current year tax levies.
What page are you
There's-
on?
I'm on page, I don't know.
Okay, I got
never
you.
bring the
Number
new-
Yeah,
3.
I know what you're talking
The
about.
first page on the revenue.
Right.
77, yeah.
If you look at the first of 4 lines, you can't tell why what's different about them. And there's something different about them.
Yeah.
But there's a lot of them like that, so I'm just saying, all it is tables of data, right? Again, if you can't do it, I think it would, again, improve the product, and it'd be able to understand what each line is for.
Yeah, no, I do have some of the suggestions you made, and some of that's
Well, again,
simple stuff that
just,
we can do.
I
yeah.
think that one would be helpful to anybody looking at the document, no matter what they understand or don't understand about it.
Okay, anybody else want to comment?
we had talked as a board about revisiting the fund balance.
We talked a
Did
little
we
bit
wanna
about
do
that at finance. The concern was even with this budget being at a surplus, we're still not at 30% or 33% of what the state recommends. So something that the finance council was first gonna see how the final budget gets approved in September, and then ask the policy council to consider revising it instead of maybe moving from 20, maybe up to 25. We're not at a point yet where we would be to 33 of what this ISBE recommends. That came up briefly in the discussion at the finance advisory, because I did ask that. I remember the board asking that. Is that something we need to consider changing that policy from 20% minimum to be higher up?
And what we told him is to keep that in his mind going forward, because, you know, as he moves the numbers within the budget, like right now, we had a $15,000 increase in revenue, but really, we had a 15,000 plus 200 some thousand in income and expense. So now, automatically, by adding the 200,000 in expense from tonight, the percentage is naturally gonna go down. So we advised him to think about this going forward. Let's see where the budget's gonna be, and perhaps bring to the policy council a recommendation of looking at maybe 25% or something. You know, we should have a fund balance that, you know, gives us that, at least that 1/3 cushion for the year, but we don't want to, you know, immediately go from 20 to 33, because if we don't make it, we have to do certain things. The state requires you to then put in a plan for how you're gonna make that. So we don't wanna have it jump up, but we thought, we recommended that the superintendent consider maybe recommending that we increase it over time. But, you know, from my personal perspective, I can't tell until we get something more finalized, where we're gonna end up. Right now, I think it says 29%.
Almost 30, 29.
Yeah, but as you add in expenses, even if it's a break even, you're
Right.
increasing the expense, and therefore you're decreasing the percentage.
And the other item is that if we put a policy in place, we have a good visibility of the next 3 or 5 years. And at this stage now, we have a big thing hanging over us right now, and until we can resolve that, I think we can, you know, then we can start talking long-term. Because what we don't want to do is put something in place, and then 2 years down the road, we're gonna have to keep changing it again,
Right. 'Cause-
right? Because, and with the contract coming up and not knowing where that's all gonna shake out,
Right.
I think we need to get visibility, and then we can come back and revisit the 1 year out, 2 year out, 3 year out, and see where it's heading.
Would that policy help shape your contract, do you think? If you say, well, this is our policy, we have to meet this, does that give you leverage or no?
No, because then they come back, and go, why'd you change the policy on this?
Yeah.
What was the policy before that?
Policy
Why'd you
was
change it
changed
back?
to.
Yeah, why don't you just change it back to what you had?
Yeah.
Well, but for 80 years, the policy was what the state recommended.
All right.
Those were desperate measures in hard times where we changed it to.
I understand, and it's, you know, let us do, I think it's
Right.
best we get clarity and it be fair to everyone.
Right.
We don't change policy until we get clarity on where we're fair to both sides.
You know, and there's other things that if we get into a life safety situation, although that doesn't affect your operating of funds, it certainly affects your, the taxpayer's pocketbook. And should you ask for anything more from them, they may not be able to, they may not vote to give it to you through on the operating side. So, you know, again, there's that also. There's 3 or 4 long-term factors that we really gotta get a little more clarity on, looking out 3, 4, 5 years. And then it'll become a little clearer. So our recommendation as the council to the superintendent was to keep it out there, think about it, as things start to fall in place and focus, to then bring it up with the policy and bounce it off the policy people when it's an appropriate time. But, you know,
All right,
And just to add to something that Mike said about adding in that additional 215,000 in expenses, realize that these beginning fund balance numbers are based on the budget for 2013. So they're also going to change when we get the actual numbers in at the end of June. So that's going to have an impact on that percentage too.
okay, so Tim and Kevin, great job with you and your team.